All right, welcome everybody again to Financially Speaking with LaBarge Financial. I'm Jason LaBarge, and this is another episode that we're excited to present to you today. We've got a special guest, Andrew Eden. Welcome, Andrew. What we're going to talk about today is kind of a broad topic on the services we provide at LaBarge Financial, some of the background and reasoning why we offer some of those services, and then we're going to do a deep dive on some of the ancillary products, some of the investments we use to not just your traditional stocks, ETFs, annuities. We're going to talk about life insurance. We're going to talk about long-term care insurance, some of those investments that can help those in retirement. And before we do that, I want to talk a little bit about kind of the vision of LaBarge Financial and why Andrew is here and the services he provides to our families. There's a concept that is referred to as the family office or the multi-family office. And these types of organizations are reserved for historically the super wealthy, all the wealthy families you've heard of, the Bush family, the Vanderbilt family, even local, like a family like the Bishattis. They by and large do not hire firms like LaBarge Financial to manage their wealth. When you have billions of dollars, you seek an organization called a family office or a multi-family office. Kevin Plank of Under Armour fame, he has a family office. And the reason that you don't hire firms like ours historically are the services provided from the family office are by and large exclusively offered to that family or to the multifamily. And it's also interesting to me because if you think about the first generation who made the wealth, John D. Rockefeller created Standard Oil, generated billions of dollars, and historically you would pass that money, that wealth. Let's say you had 5 kids, you would pass 20% to each kid, and then that kid would then use that wealth, and then he'd pass that on to his family. And so through 4 and 5 generations, what John D. Rockefeller created was spread out, it was gone. And so instead of doing it that way, the family office was created to say, look, we're going to keep that wealth in one organization, in one place, and then these multi-families, these cousins or multi-generations, they're going to live off of that wealth. They're going to not inherit it necessarily. They're going to basically go on payroll and be provided for instead of just giving millions of dollars. And then that allows the family office to invest that in not just stocks, bonds, annuities, mutual funds. They certainly have an allocation into that asset class, but they're also buying things like restaurants, and in the case of the Bishattis, the Ravens. In the case of Kevin Plank and Under Armour, they're buying Sagamore wine, and so it allows them to invest in alternative assets and not have it be all of their wealth. And so it's really a fascinating idea. And not only is it investment management that these organizations offer, it's also tax planning, estate planning, other legal work, life insurance planning, college planning. And so when I thought about how I wanted to build out LaBarge Financial, the multi-family office is what I've sought to create. And that's unique in our marketplace. A lot of financial advisors exclusively focus on investments and financial planning. And that's certainly something we do as well. But I wanted to branch out and to offer legal, tax, Social Security, Medicare planning, life insurance planning, long-term care planning. And so that's really what we've set out to do. And it's been a few years to find the right people to do and perform those roles. And I feel like we've never been at a better place than we are now. And Andrew is one of those people that we found to provide these services for our clients. And so we wanted to, within that context, talk about what that family office is and then what roles each professional has. And so today, Andrew's going to join us and talk through about some of the things he does And then we want to talk through some of the details of life insurance and the different plans that he offers. And I'd like to also spend a little bit of time on talking about premium financing. I think that's a unique benefit that we offer our higher end wealthy clients. And so today, Andrew, why don't you first welcome?
Thanks for having me.
I appreciate it. Thanks for being here. Talk first, just briefly, a little bit about your background and who you are.
Yeah, sure. So I actually grew up in Annapolis myself, born and raised here. Most of my family's in the area, but went to school out west, and then came back here once I had my kids here. But actually started off as a client here at LaBarge.
Yeah, you did. Yeah, you did.
Via my in-laws.
Yeah, you did.
And then
Where'd you go to school?
went to University of Colorado Boulder.
Buffalo.
Yeah.
What do you
Let's
think
go
of Deion
Bucks.
Sanders?
I think he's doing a good job. I mean, we went
Yeah.
from being 1-11 to, a little
Yeah.
bit better than that.
What'd you think of Boulder?
Boulder was great. Just enjoyed being, a student, able to do outdoor things and also, do my studies, of course. But loved it out there. Great school, great community to be a part of. But
So you were in Colorado and you just had to get back to Maryland.
yeah, had to come back once I had, my first boy. I was like, yep, it's
Where
time to
did
go
you
home.
meet Ashley?
So we actually met in Baltimore at McGurk's in Baltimore.
You were
Federal
already
Hill.
back.
Yeah, I had moved back
Ashley's
after
his wife.
school.
Ashley's
Yeah,
your wife.
Ashley's my wife. I had moved back from Colorado after college, and we met up in Baltimore.
So you were already back. So it wasn't that Ashley that brought you back or whatever. You had already knew her. Got it. So talk through some of the things that you do here and some of the things you've done for our families thus far.
Yeah, sure. So, I mean, for me, what's really great with working with clients here is showing them the power of life insurance beyond just strictly coverage, I would say. I mean, a lot of people think of it strictly in terms of what we call the death benefit, but there's a lot more that you can do with it outside of that. One being, with pretty much any life insurance policy, the death benefit is going to be tax-free upon your passing. Creditors can't come after it. It is a huge infusion of cash, for a family typically that they can use to, for that family member had that policy, maintain their home, get it ready to put it on the market, pay off any estate taxes, anything like that. So I really like working with families on how they can really protect, but also transfer their wealth. Because if you're going to transfer your wealth, you want to do it in the most tax efficient way. So
no, I think that's been the biggest surprise for me is working in the industry as long as I have. Life insurance was something that I thought was more for younger folks.
Yep.
And as you aged, you didn't need it any longer. And that thinking, and for me, has totally changed. Seeing the value of the tax efficiency. IRAs are generally what most of the wealth of a lot of our clients are in, and that goes so inefficient to the next generation, especially now with the stretching being minimized to 10 years. That getting that infusion of capital tax free is so vital.
Oh yeah.
And has it been difficult for you with clients buying into the idea of life insurance, being older, being closer to retirement? Has that been an easy transition, or talk about that?
I mean, I think, it's really getting someone to really think differently about life insurance, as you kind of mentioned a moment ago, which is most people think of it as something you need when you're younger. It's really to protect your income, which it certainly can be that.
Sure.
But your needs for life insurance will evolve over the course of your lifetime. I mean, whether you have kids or not, you want to replace your income if you were to pass away in your 30s, your 40s, and your 50s. But when you hit your 50s, you want to start thinking about how you can prepare for long-term care events, because unfortunately, I mean, most of us will need long-term care. So
in some way, shape, or form.
Yeah. And there's different ways to approach that, but it's really getting clients to think about how can we use life insurance beyond just strictly coverage as people think of it, so we can think about transferring wealth via life insurance. So that's been kind of just the way people need to start thinking about in terms of just strictly coverage. How can we?
Has that been a challenge?
For some people it is, because they really do focus in on strictly the coverage, but also
or they look at the cost. Yeah,
the cost is, sticker shock is a real thing, but when you put it in terms of, hey, look, we have all of these qualified, accounts here that we're either not drawing on or, we could use in a more efficient way. Why don't we look at, taking some distributions now, for example, which you're going to have to start doing when you have to do RMDs anyway, so that we can get that money out now and put it into a tax efficient vehicle in the
Yeah,
future.
totally. And to get somebody to understand that you're shifting assets, you're not buying something, right?
Right.
You're not spending. People think that when they see the cost of something, their mind jumps to it's like buying a car, or it's
Yeah.
like buying a house, or it's buying a pair of shoes. Where after a certain period of time, those shoes are going to wear. It's over. That money's gone. Where with life insurance, it's an investment, and that's what people don't sometimes understand,
Yep.
that you're taking money and you're putting it into an account, therefore sliding it from a taxable to a non-taxable bucket.
Yep.
And that's hard for people to get, which is why um, I wanted to have a separate role, somebody doing that here, so we could spend more time focusing on that.
Yep.
That's why I want you on this podcast, so people can see that it's an investment. It's not a purchase. So the cost isn't like taking away from something. You're shifting it from one bucket to another.
Yeah, and you typically get it back, or your
For sure.
family does.
Somebody does.
So, that's kind of the way to look at it in terms of an investment in the future.
Because I could even say in both instances, let's say you have two clients. One client is going to spend all their money. The other client is not going to spend all their money. I could make a solid argument that life insurance is appropriate for both of those people. So client A, who's going to spend all their IRA or savings, those folks then get to leave a legacy,
Yep.
right? They're going to spend all of their savings, their 401k over their lifetime, living their life, etc. But then they get to give an additional bucket of money to somebody after they pass. That's amazing.
Yeah.
Leave that kind of legacy, kids, grandkids, etc. Then for that second group, somebody that might say, well, look, I'm not going to spend all this money. We had a family we were talking to this morning, longtime clients of ours. They won't spend all the money that they've saved, more than likely, barring a crazy emergency or something. You can make an argument that they need life insurance as well, because then you're talking tax efficiency. Do you want to give somebody an IRA money that they're going to give half of it or whatever, 45% of it to the IRS? Or do they want to give that tax-free? So I could make a solid argument that both sets of clients need life insurance. Two different reasons, though.
Yeah, I mean, do you want your secondary or contingent beneficiary to be the IRS, or do you want it to be your family?
Right.
So
right. And life insurance, there's a way of, but there's just something about it that people just don't want to talk about. They're uncomfortable, and not everybody, right? I wouldn't even say the majority. I would say the majority of clients understand that life insurance plays a role, and so we're talking about a minority set of people here that just focus on your cost, but I think we've been at this a year. We've had a lot of success. I think clients are understanding the value. And then what I just talked about was just the death benefit piece, the legacy piece. That's not the only value that life insurance offers.
Correct.
What are some other benefits folks get from life insurance?
So one would be, if you have a cash value type policy, that can be used to supplement your retirement in a tax efficient way. There's various ways to approach that, but you typically do that through like a policy loan, because you can't tax a loan necessarily when you take it out of a cash value policy. So that's how people are using their life insurance policies
for income.
Yeah, for income in a sophisticated way,
right,
beyond just normal baseline death benefit. So
somebody buys an account today. Mm-hmm. They're paying their premiums.
Yep.
Let's say for the next 10 years. Mm-hmm. The cash value in the plan is accumulating.
Yep.
And then at a point, 10 years from now, 6 years from now, whatever, they start taking loans from it. And people get nervous when they hear the word loan.
Yep.
Because they think it's a bank loan.
They think of their mortgage.
I don't want to go into debt.
Right.
Loan is just the terminology for the function of just taking withdrawals out. They call it a loan, so it's not taxable.
Exactly.
Whether you want to pay it back is entirely up to you. If a person does not pay it back, then at their passing, that loan amount is going to be reduced from the death benefit that ultimately goes to heirs. I think that's an amazing benefit. Because it's tax-free.
Yeah. Yeah, I mean that's a huge benefit of using a cash value
Yeah.
life insurance policy to your advantage. And it's not like you would be solely allocating all of your money into a life insurance cash value policy, but it's a great way to supplement your retirement
But
on
is the
top of
money growing when it's in the policy itself, right? Like if you're
yes.
paying premiums, how is the money growing?
So when you pay a premium, you're putting part of that money goes towards the cost of insurance.
Sure.
Part of that money is going into a bucket inside of that policy that is growing based off the performance. Typically, I will link it to like the S&P 500, just because it's one that people are really familiar with.
Sure.
It often is performing pretty
Performing
well. And we're looking at compound interest.
So
on
the
it.
money's earning
Interest.
from the S&P.
Mm-hmm.
So it's like an investment inside of the life insurance plan.
Correct.
Can it lose?
Can it lose? No, I mean there's no floor, or there's a floor of zero on IULs, for example. But the exchange you have for that is that you typically have a cap.
You're gonna have an upside ceiling.
Yeah.
Yeah.
Just like you would have with a buffer account,
Totally.
So
Yeah, we use index buffered a lot, and same concept then. Okay, so you have money going in, your cash value is accumulating. It's growing at an index, provided the index, performs and you hit. But if the index is negative, you don't lose like you might in another investment or something.
Yeah.
And then every year you're getting a statement that's illustrating what your cash value is.
Yep.
And then you hit retirement and you start taking withdrawals from it like you would in a 401k or an IRA.
Yeah.
Wow.
Absolutely. Yep.
Wow. And you don't pay it back.
No, you can, but you don't have to. That's the thing.
If you pay it back, then your death benefit maintains what you had it at.
Yeah, exactly. So when you pass away with a loan balance on an indexed universal life policy or cash value policy in general, it's just going to be deducted from the death benefit.
Is that the same thing that's happening with long-term care?
With long-term care, yeah. So if you have a policy with a long-term care or chronic illness benefit, which is about the same thing,
Sure.
If you're drawing off of that while you're alive, you're drawing off the death benefit. So whatever you haven't drawn off that death benefit is going to be there for your family when you pass away.
So if you have a plan, or you have a policy,
Mm-hmm.
and you have some cash value, let's say you bought it 15 years ago, let it accumulate, you've been paying your premiums, and then you need a nursing home or assisted living or what is it, the ADLs?
Yeah, the activities of daily living.
2 of 6 or whatever?
2 of 6, yep.
So you're unable to perform 2 of 6 activities of daily living. You then start pulling the cash value to pay for nursing home, or you're actually pulling from...
You want to look at it in terms of the total death benefit, because the death benefit, part of the death benefit is going to be the cash value. That's your self-insured.
Yeah.
Essentially amount, and then the difference between the cash value and the total death benefit, that's what you're paying in the cost of insurance. But combined together, if you have a $300,000 death benefit policy with $150,000 in cash value, you're still drawing off of that $300,000 for long-term care, regardless of what that cash value amount is.
But if you died, you have $450,000.
If you pass away, if you have a level death benefit with an indexed universal life policy, you would have the $300,000.
Not the $450,000.
If you had a increasing death benefit, you would have the $150,000 plus the $300,000, which would be $450,000.
Interesting. So you pick what death benefit feature you want.
Yep.
When you buy it.
Yep.
And the increasing probably has...
It's more expensive
some cost to it.
Yep. But it really depends on the situation. It's not like one's worse than the other. It really depends on what the purpose of it is. I like to do level typically because a lot of people are trying to keep their costs down.
Cost down, sure.
But if you're younger, for example, you might want to have more death benefit than if you were somebody who's a bit older.
So if you, let's say you took the level, we would advise you more than likely to take that $150,000 cash value out, which would then invest it, do something with it, and then at your passing, somebody's still getting the $300,000 in our example. Wow, yeah, it's those types of things that make life insurance so fascinating. It's almost as if I wish they would name it something else. Like if people just have a misconception or a preconceived notion on what life insurance is, and what you just described is something completely different than what
people
most
think.
people's
Yeah.
preconceived notion. And so
Yeah.
the only thing that what you just described that has in common with life insurance is the death benefit and the name, I suppose. Right? You pass away, somebody's getting a plan tax free, but that's to the benefit of us, right? The fact that it's still tax free, which is not a given. You know, I used to be a part of NAFA, which was like the National Association of Insurance Financial Advisors, something. And every year they would have a group that would have to go lobby DC, Washington DC, to keep life insurance
And the tax
free.
Yeah.
And I you just think
they changed it back in the 80s.
Yeah.
You could just put as much
You could
money
fund
into
the
it
heck
as
out-
you
yeah, you
wanted
could
to,
fund
and
the heck out
Congress
of it.
is like,
So,
wait, we need our
do we get
taxes.
chill on that? Yeah. No, we used to call that a power Roth, right? Like
Yeah.
the most somebody can put into a Roth IRA is $8,000. You can put you can't put whatever you want in the but you can put more than $8,000 to fund to contribute into a life insurance plan and never even really have any idea or any desire to use it for a death benefit. But you have the loans in there that you can take out and use it for income. I think that's fascinating, especially if you can get some growth on it from an index or performance, and it's not just staying level. I think that's an amazing benefit for people to have.
Yeah, no, it absolutely is. And, it's just another way you can diversify your portfolio. And, for a lot of people, just put money to work that's otherwise going to be heavily taxed upon their
Well, and then
passing.
you got to take the RMD out anyway, like you said.
Yeah.
Right. So the premium amount for most of our families can be easily paid by the RMD withdrawals that you have to take anyway.
Right.
And I've always been a big proponent of not waiting till RMD age. You're essentially kicking the can into the future to pay more in taxes on a higher amount. And so start the process now and shift it, not like shifting that money out of an IRA into a tax-free, L share class that gives you a death benefit if you pass away. I just, and it's important to note that we've had a ton of success. We've had several families after talking with you add this to their portfolio. But one of the challenges is underwriting.
Yep.
Going through the health underwriting is probably in my view, the worst part about buying life insurance. There's a lot of benefits to it. Anytime you're getting a free exam is a good thing.
Yeah.
But talk about underwriting and how that process involves and who's doing it and just talk a little bit about that.
Yeah, sure. So, I typically help folks submit the application, get that process started. They'll do their health questionnaire, whether that's on their computer at home at their convenience, or we'll have the carrier give them a call and walk through those questions with them. But once you submit that, you may even qualify for accelerated underwriting. So that means that they won't even have to do a physical exam. The only way to find out is to accept that you could still do a physical exam. But so some people will get that, some people don't. But regardless, they like to make it convenient for you. They'll send someone out to your home.
Yeah, they want to make it as convenient as possible.
And it's no cost to you,
Right.
And they do want to make it as easy on you as possible. I mean, the whole application is free itself, but underwriting is the most time-consuming part of it. But it's well worth it when you can see what's on the other side. And, I can talk to people about quotes all day long, but these are really just hypotheticals until we go through underwriting.
Right.
And once we get those real numbers, we can start making decisions. No offer is necessarily final. If you get approved for $10,000 and you want to spend $8,000, we can see what that, premium of $8,000 would get you.
Yeah,
so, just knowing that nothing is set in stone and the process is free, underwriting, I feel like is well worth it.
So, and we assist our families going through underwriting. And just because you might decide to go through underwriting doesn't mean that you're deciding to purchase the policy either.
Right.
We encourage those that are potentially considering this to go through the underwriting process, see what offers we receive, and then make a decision if you want to move forward.
Yep.
I think that's the I think that's the way to go. You're not, even by, going through underwriting, you're not committing.
Yeah. And, some people are like, oh, I'm not insurable, or it's just going to be so expensive for me. And you just want to think, well, we haven't had someone really evaluate that yet. So
Right.
why don't we have someone take a look at you and determine that, and then you can decide.
Totally. And underwriting's not that cumbersome of a.
It's really not. I'm here to help all the way through the process.
I mean,
so
locating doctors' phone numbers might be the hardest part.
Yep.
Or their office phone number. What's important for me to communicate, I would say that if you looked at our top, we manage almost $900 million. I almost said $1 billion. That'd be too much.
One day.
I wish. Yeah, maybe. $900 million. And if you looked at our top 50 wealthiest clients, I would tell you that 45 of them have a life insurance plan.
Yeah.
They all do. And that isn't to say that just because they do, everybody else does. I just think that it's such a important and additional benefit. I was going to talk about premium financing. That's something that you and I have, started to discuss and look into. Talk briefly about what premium financing is, and then I'd love our audience to connect with you. We may look to do other, like a webinar or something on it, but talk a little bit about what premium financing is for our audience.
Yeah, sure. So premium financing a life insurance policy is one that has cash value to it. So essentially, you apply like you would if you were funding the whole policy yourself, but you're being partnered with a bank who is actually loaning you the premium that you are paying for the policy. Now, since it's a cash value policy, the loan is going to be the collateral of that policy is the cash value for that loan that you're taking.
Yeah.
So with an index universal life policy, you're having that compound interest grow year after year after year on that cash value inside of the policy. And once your cash value is above about 20% of what the loan value was that you took out, you are going to take the collateral of that cash value and switch it from the bank
and pay the loan off
over to you and pay the loan off.
In other words, you can use bank money to make the premium on your life insurance policy.
Yeah.
So you don't have to pay for it yourself.
Correct.
Right. So if you buy a $2 million policy and that costs $20,000 a year, you may only feel comfortable paying for 10.
Yep.
The bank will pay for the other 10.
Yep.
You have the cash value accumulating in the account. We're going to take the cash value and pay off the loan at a certain point in the future.
Yeah. And
Brilliant.
A huge benefit of it is that if you didn't finance it yourself, you wouldn't be able to get as much death benefit.
Right.
But since you're getting it financed, you can get a lot more death benefit.
Instead of buying $1 million, you're buying $2 million.
Yeah. And another huge thing is that people don't even think about it this way, but if you have, grandparents that really want to fund their kids or grandkids' college education in the future, this is a great option for you to set aside those funds for them to access when that time comes.
Yeah.
And it's a great vehicle for growth and wealth transfer in the future. I mean, you can do it for yourself, your kids, your grandkids.
And we've got a group that will walk us through the entire process, don't we? We've got
we do work with a company that
will do that. They'll find the bank. They'll do.
They have all the relationships already set up. With the insurance companies, the banks. It's just with
our ultra net worth clients. I think that's something we're gonna pursue. But it doesn't necessarily have to be for the ultra net worth either.
No,
because I was looking at it for myself and my wife. We got to finish that conversation.
Yeah.
So it doesn't have to be for your Donald Trump's or your Jeff Bezos, right? The whole idea of that group is bringing the idea of the premium financing to everyday people.
Yeah,
it's the way I understood it.
Yeah, it is. And the other thing too, earlier you mentioned, our high net worth clients often have life insurance. Not all of them, but some of them. But I don't want people to think necessarily that you can't have it, if you're not high net worth. These are options that are available for anybody.
That, again, totally. The whole idea of the family office is I want to bring services investments that were historically only for the high net worth.
Yeah.
To all of us. I'm not a high net worth, didn't come from a family of high net worth folks. And
Yeah.
so, but I loved the idea of having access to those similar investments and strategies.
Yeah.
And life insurance is certainly one of those. I think if you're just using it for death benefit, you're kind of missing the boat. It's
Yeah.
that's a basic elementary way of using life insurance, but there's much more sophisticated ways to use it that your average retiree can do, especially for those that can go through underwriting. If you can go
Yeah.
through, get a standard rating or certainly a preferred rating, it's worth the money.
Yeah. Oh, absolutely. And even if you're not sold on the idea, even if you don't think you're insurable, just come talk to me,
Yeah.
because really the only way to find out is to go
Is
through
to go through it,
underwriting,
yeah.
and then you can say no if you want.
And
But
underwriting isn't that big of it's not that big of an issue.
it's really not.
Yeah, it's not.
Yeah.
Yeah.
And a lot of people will qualify for accelerated underwriting, which means they don't have to do an exam.
Yeah, that's right.
They're just pulling records.
No, it's great. So, Andrew, thank you for coming on.
Yeah, no problem.
I encourage all of our audience to speak with Andrew. Certainly for those that are under 40 and you've got young kids, life insurance is an absolute must in that scenario. So any of the child of our clients or friends, family members, we've got Andrew's contact information available. And again, want to thank you all for your time. Be on the lookout for more episodes coming for Financially Speaking with LaBarge Financial. Again, Andrew, thanks for coming on. All right, guys, have a great day. Thank you. Insurance products are offered through the insurance business LaBarge Financial, LLC. LaBarge Financial is also an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by LaBarge Financial are not subject to investment advisor requirements or broker-dealer requirements. Securities offered only by duly registered individuals through Madison Avenue Securities, LLC, MAS, member FINRA SIPC. AEWM and MAS are not affiliated companies of LaBarge Financial. Tax planning services are offered through the firm LaBarge Tax, LLC. The tax planning services offered by LaBarge Tax are not subject to investment advisor requirements. Tax planning services referenced are an outside business activity not offered through or supervised by AEWM or MAS. AEWM and MAS are not affiliated with LaBarge Tax. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. LaBarge Financial and LaBarge Tax are not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firms are not affiliated with or endorsed by the U.S. government or any governmental agency. This information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by LaBarge Financial or LaBarge Tax.